Hello and welcome. I'm Bud Milligan, Certified Financial Planner and Wealth Manager with Milligan Wealth Management. You're watching Your Financial Bud, where every week we dive into timely and helpful personal financial topics. Today, we're covering highlights from the LPL Research 2026 Outlook, titled The Policy Engine. Now, this report comes from a highly respected research team and is packed with insight into what we can expect in the coming year. The report opens with a letter from Chief Investment Officer Marc Zabicki, and this is a must-read. Marc does an excellent job painting the picture of where we've been and what new factors we need to consider moving forward. In this video, I'll summarize the key points from the Outlook and share a link so you can get your own copy. Here's our agenda. We'll start with the economy, and then we'll review LPL Research guidance on stocks, bonds, and portfolios. While the report also discusses alternatives, currencies, commodities, and geopolitics, we're not going to cover those today, but make sure you get the full report and review those sections. They're especially important for portfolio management. Now, sit back, take notes, drink some coffee, and remember, you can always reach out to me with any questions. Let's start with the economy. The U.S. economy is expected to slow early in 2026, but rebound later in the year thanks to ongoing investment in artificial intelligence and continued fiscal spending. We may see weaker household activity, a cooler job market, and lower consumer demand, which should help limit inflation, even though price pressures remain. The Federal Reserve is expected to cut rates gradually, balancing inflation concerns with a softening job market. The Fed is anticipated to cut rates by 75 to 100 basis points throughout 2026. U.S. economic growth will likely be below 1% annualized in Q1, but should pick up in later quarters. Core PCE inflation is expected to decelerate to 2.5% by year end. The labor market will play a key role with softer income growth, which could impact spending. And then there's AI-related investment. That will become a larger part of economic growth. The bottom line that LPL Research identifies in this outlook is that they expect the U.S. economy to avoid a recession, supported by higher income consumers. As the Fed cuts rates, retail rates should also fall. Housing costs and rents are likely to improve, while consumer prices will slow but remain a concern. Business investment in AI projects will also help drive growth. Now, let's move on to stocks. The bull market may continue into 2026, fueled by AI optimism and an easier Fed policy. However, high valuations and midterm election volatility could limit returns. LPL Research recommends keeping current allocations and waiting for those market dips before adding more equities. Be sure to check out the Outlook's guidance on which sectors to consider: overweight, underweight, or neutral. Historically, investors have seen strong returns in the fourth year of bull markets. Spending by hyperscalers, or those companies growing at hyper speed, is expected to climb by 30%, reaching $520 billion in 2026, which could drive strong double-digit earnings growth for the S&P 500. The Fed's rate-cutting cycle aims to return policy to normal levels, supporting the market rather than preventing a recession. Risks include limited participation among stocks, closer scrutiny of AI investments, higher long-term interest rates, and uncertainty from the midterm elections. The takeaway is that the 2026 stock market may look a lot like 2025, with continued cycles driven by AI and rate cuts. High valuations and volatility mean strong returns are not guaranteed. Keep equity allocations steady and consider increasing exposure during market corrections. Stay alert also for opportunities. Next up, bonds and cash. LPL Research finds bonds attractive for income, with yields expected to remain elevated. The 10-year Treasury is likely to stay in the range of 3.75 to 4.25%. Investors should focus on income. As the Fed lowers rates, cash returns are expected to decrease, making high-quality, intermediate-term bonds more appealing. Fixed income returns should be driven mainly by yield, so LPL favors securitized markets and agency mortgage-backed securities over investment-grade corporates due to those increased risks. High-quality bonds are expected to outperform cash, while riskier credits may lag unless rates fall or spreads narrow. There's a slight tactical preference for high yield over loans. Finally, portfolio recommendations. In a rapidly changing investment landscape, LPL Research recommends maintaining a balanced, diversified portfolio across asset classes and regions, including alternatives for added stability. Monitor market volatility closely to capitalize on equity corrections. You'll find their portfolio tactical outlook at the end of the report, including specific recommendations on where to be strong, overweight, neutral, underweight, or strong underweight. That's a quick summary of the LPL Research team's outlook for 2026. We covered the economy, LPL's guidance on stocks, bonds, and portfolios, but there's a lot more in that outlook to unwrap. If you want your own copy of the report, visit my website at milliganwealth.com. Scroll to the bottom and request a copy using our Have a Question button. And if you have questions or want to talk, schedule a time with me using the Let's Talk button. Consultations and questions are free, so don't hesitate to reach out. Thank you for watching. If you enjoyed this video, please like, subscribe, and share it with others. Join us next week for our video on Medicare as we kick off Medicare General Enrollment in the first quarter of 2026. Until next week, I'm Bud Milligan, your financial bud.